Mr. Chairman, thank you, Chair Yellen, for taking the time to be able to be here today. We've heard comments from our colleagues across the aisle in terms of the disparate impact that we're seeing in a failed economy for minority communities, and I'd like to be able to expand that actually for what we're seeing in rural America as well, where the economy simply isn't moving, and one of the key components for that is obviously access to capital for our community banks. You just cited a few moments ago, it's been a difficult period for community banks. Regulatory burdens have been high. And I guess what my question is, this follows up on comments that you'd made earlier in the year, which were then supplemented by FDIC Chairman Sheila Bair as well, that we've got an overzealous regulatory burden which is impacting some of the community banks that are going in. What assurances, what policies are you going to be putting forward? Because it seems to be that through Dodd-Frank, it's a matter of shoot, then aim. And now we're trying to be reactive, but at home, our people are feeling the pain of bad policy that's come out of Dodd-Frank and what we're feeling, and what are you going to be doing at the Fed to be able to alleviate this?
Well, we are very focused on community banks. We want to...
That's what they're worried about, by the way.
We formed a council called CDAC that consists of community bankers, and they come to see us twice a year. The entire board meets with them. There are also, in each of the 12 Federal Reserve districts, versions of on a regional scale of a council to advise the reserve banks on factors affecting community banks. So we are listening. We are taking seriously the complaints that we hear and the specifics about our supervision and trying to be responsive. We've done.
No, I appreciate that, but if I can put a little exclamation point on this. Sat down with community banks in my district. They feel that they are no longer working as a banker, but they are working for the federal government. They are working just for to be able to comply with regulations that are currently in place. And while we may have hearings, they don't feel that anyone is actually listening because this is stagnating that growth in those community banks.
Well, we are listening, and we are taking a series of steps that I believe are meaningful to reduce burden, including reducing the amount of time we spend in these banks, disrupting the other activities that they want to be doing by reducing our demands for documentation, taking a more risk-focused approach to reduce the burdens of exams. We're trying to make clear to the community banks what's relevant to them, and so many of the regulations under Dodd-Frank we've put in effect only affect larger banks, and particularly the most systemically important banks.
But you do recognize that a lot of our community banks de facto feel they still have to be able to comply with those Dodd-Frank regulations, even though you're saying we're going to look the other way. It doesn't really apply to you. They're still feeling the impacts that are coming out of Dodd-Frank.
Well, there are some things that Dodd-Frank imposed on all firms. For example, the Volcker rule could envision their community banks being exempt from Volcker. Now, we're trying to tailor our implementation of Volcker to utterly minimize the burden on community banks, but they are subject to it. There might be some steps that
we just introduced legislation for tailoring bank regulations. We have 55 different banking organizations that have endorsed the legislation. We hope you will too, because we've got to be able to get the economies moving in rural America and our minority communities, because when we're looking at that 5.3 and we're talking about, as Mr. Rothfuss had pointed out, a real unemployment level that's 10.5%, is part of the problem when you aren't raising interest rates right now is what you're really saying is our economy stinks right now. We're just not seeing real movement and what tools do you have left in the toolbox to be able to stimulate this?
Well, I would say we've gotten our economy is in a much better state. Low interest rates have facilitated it, and a decision on our part to raise rates will say, no, the economy doesn't stink, we're close to where we want to be, and we now think the economy can not only tolerate but needs higher rates. So there have been headwinds, and we've tried to use monetary policy to overcome them. But I want you to know that we share the goal of minimizing burden on community banks, and will remain very focused on it. We have the Agrippa process that is in play at the moment, and it is focusing particularly on burdens in community banks.
Time of the gentleman has expired. The chair now recognizes